Hi everyone, today I'm going to talk about the 5 stocks that I've been buying. So I bought these 5 stocks not the week that's just gone, the week before. So I'll update you guys so it just keeps with that transparency, especially right now with this dip that we're on, so you guys know what stocks I'm buying and the ones that I think are really good opportunities to be buying in this bear market. So yeah, I'll spend a minute or two on these stocks. I won't do a full deep dive just because the video would end up being like 3 hours long. So yeah, they'll be like 3 or 4 minutes long. But if you do want a full video on the stocks I'm talking about, I probably do have a full video on them on the channel. But yeah, we'll get started on these 5 stocks that I've been buying. I have to say as well, the feedback on the video yesterday about the new setup was pretty positive, so thank you very much for that. And as always, if you wonder what I'm buying and selling in real time, Patreon is the place to be. You can join through that with a link in the description. I post when I'm buying and selling companies in real time on there, and also there's 2 exclusive videos a week on the Patreon. There will be a video up in the next few hours for the second exclusive video this week, which will be a bit more of an educational video today. But we'll get stuck on these 5 stocks, starting with number 1. And it's a stock that I actually probably should have bought a bit more of recently, which is Callaway Golf. Yeah, I probably should have prioritized this a little bit. Now at the moment, Callaway is having a bit of a fair dip with what the market's doing at the moment. You can see here that it's down 43%. But prior to that, around about May time, I think that's probably when we can say that the stock market kind of really started to have its slump. Obviously, it kind of got a lot more extreme in November time when a lot more of the big tech started joining in. But prior to that, a lot of the small market caps, which Callaway Golf is at a 3.8 billion market company, that's when they really started to dip, and yeah, this one joined in. And before that, it was actually doing quite well. You can see it actually had a run up after the COVID incident, and then it went a little bit higher, and it deserves to do it because I mean golf sales have been strong since COVID, and also there's been an acquisition that it's made, which was the whole reason why I got into this business. Callaway has always been a company I've tracked. I always thought they were a good product selling the golf equipment and the apparel equipment that they do have. But they made an acquisition, and the acquisition was what really got me across the line of buying this one, because I was actually tracking this in case this company IPO'd, which was Topgolf. So I was always watching Topgolf and thinking, if this IPOs, I think this is a really good business model. I'll buy it at an IPO. And there was rumours that it was going to IPO, and it was going to be around about 4 billion. Now, next thing we know, we're coming out of this CV situation, and Callaway buys Topgolf for 2.6 billion. So first of all, I was thinking, okay, Topgolf is a company that I really am interested in, because I think Topgolf is a fantastic business. If you don't know, this is basically Topgolf. There's all these like driving ranges, and they're mostly in America at the moment. You'll see the venues really start to ramp up this year. But basically, you know, you've got the driving ranges, which you can go to if you want to just have a bit of a chill time, maybe go with your friends, you might do a bit of a party. They also have the bars there, they have restaurants there. So there's a bit of like a Hollywood Bowl kind of thing coming on here, where they make really good sales from actually going there, but also people might go there just to go to the bar or to have some food, and also the extras you get from people doing that, and also introducing them to golf and potentially golf sale equipment as well. There's a lot of add-ons here, and I thought this is a very good business, and I can see this being, you know, these venues popping up around the world, and they have been doing, you know, the venues that have been popping up have been really successful, and I think more and more will start ramping up with Callaway Golf. So I've always wanted to have Topgolf, and when Callaway bought it for 2.6 billion, I was like, okay, if I buy Callaway Golf now, I'm getting a really good equipment maker, you know, really good brand, you know, good reputation, as well as having a really good brand and reputation of golf equipment. This is making them the complete business here. And the thing is, they bought it for a steal. Like I said, you know, 2.6 billion. I was thinking that Topgolf was going to IPO around this 4 billion mark. And yeah, I thought, okay, I'm going to be taking this opportunity right now. And like I was saying, you know, you look at the revenue, and it's done so well after this, you know, Topgolf acquisition. They're doing good amounts of profit, and that revenue and profit is going to ramp up in the next few years. And the thing is, I think like a lot of analysts aren't actually predicting that well how much Topgolf is going to give Callaway Golf, growth, because historically, you know, Callaway's only grown, you know, 2-3% a year. I mean, if we can go on the past performance here, a little bit of a ramp up because people went a bit crazy going to do golf towards the back end, and also Jack Wolf skin acquisition that they made, but they've never had the growth that Topgolf's going to give them. Topgolf is really going to make them grow unbelievably fast right now, and as well as that, you know, the profit they're going to have from Topgolf is going to be exceptional, and yeah, the company's just performing really fantastic. You know, it's performing that well that the outlook in the recent earnings was hiked up, and the see here drives higher on earnings, and also the growth on Topgolf was exceptional, which is great. even analysts were on the conference call going, you know, how is your share price doing so badly when the company's performing so amazing? You know, Top Golf blew numbers out the water. Even apparel and equipment was still very strong, and it's doing that well now that even Callaway are like buying back shares massively. So they just announced another 100 million buyback program. So yeah, I'm really impressed with this company. You know, the Top Golf is definitely what I bought this investment for. But even then, you know, the Top Golf's amazing. The equipment's still doing very well. The apparel's still doing very well. I think it's a fantastic business. So yeah, I've been buying a bit more of Callaway Golf at the moment. I think this is definitely a 2 exit in the next 5 years. Next up is a house builder, which is Barrett Development. So same again, this has had a massive fall off since around that April 2021 time, down 40% at the moment, and it trades at 7 times earnings. I mean, house builders are never going to trade at really high valuations, but at 7 times earnings, I think this is a little low. I think this should be maybe towards 11, 12 at least. It also holds a 7% dividend yield as well, which is pretty fantastic. And at the moment, you know, the reason why it's down, I think, is because people are worried about inflation pressures. Will this affect Barrett Developments? But also I think people are factoring in, you know, an economic slowdown. Will the housing market slow down? And everything at the moment is suggesting that it's just as strong as ever. And in fact, even if the housing market did slow down slightly, it won't last for long, because in the UK we're so short for housing. People come in and buy that dip straight away. And as well as that, you know, house prices are going up so fast at the moment that even if they pull back slightly, the housing prices are still massively ahead of where they were, say, in 2019. So the revenue and profit will still look very strong and give them more growth, to potentially hike up the dividend, which I'm mainly playing this for. I think I will get some share price appreciation from this one, but I'm mostly playing this as a bit more of a safer kind of dividend stock. So yeah, if you look at the valuation at the moment, I think it's quite cheap at 7 times earnings. Compare that to, which, by the way, this is Simple Wall Street. It's what I use in my videos, and if you want to join that, there's a link in the description. You join through that link, you'll actually get a 30% discount code on the 5th day. I think it's a fantastic platform. But when you look at the price to earnings, I mean, all house builders are massively sold off at the moment, but Barrett Developments is a little bit cheaper than all the other ones, like Taylor Wimpey, for example. And if you look at the past performance, you know, it's not a fast grower, but the revenue just slightly moves up in the right direction. The profit just slightly moves in the right direction. It's kind of everything you kind of want with a business that has this kind of, you know, dividend history. Gives them a little bit room every year just to hike up this dividend. You can see that dividend, the history of that dividend being hiked up through the years. You can see actually at the moment they're forecasting in the next few years this to actually get to a 10% dividend yield if it stays at these sort of prices. Strong financial health wise, you know, there's not much debt on there. It's pretty well on cash as well, which is great. And one of the really big positive signs at the moment is there's been a bit of insider buying going on, which is always a really positive when you have a company and the insiders are buying the stock. So yeah, this is a bit more of a value play and a dividend kind of play. I think I'll get some share price appreciation, as well as that I think I'll pick up a lovely dividend. So yeah, don't be too surprised if you see me buy this a little bit more. I think even if you're not a fan of Barrett Developments, I'd be looking at someone like Taylor Wimpey or something. I think the UK housing stocks at the moment are pretty good opportunities. The third stock was Meta. So if you told me like 2 years ago that Meta would be at $170, I won't believe you, but it's happened. And you look at this here, and I mean, it's, you know, you're talking nearly 2017 levels where it's at, and it's trading down at a PE earnings of 12, which is just insane. I cannot believe that Meta has had this fall off, you know, from $378 down 54%. And I mean, I know Meta's going through some problems, as a few companies are, especially these marketing companies, the Apple changes. But I mean, I don't know what the market and Wall Street are trying to value at it, because Meta might have some problems in the short term, but in the long term, it's still going to be a fantastic platform. You know, Instagram's still going to be popular, Facebook, WhatsApp, Messenger will still be popular. And then you think about the investments into Oculus, virtual reality, the metaverse. I mean, these could really be the next kind of growth drivers for Meta, where it grows at really good rates. And even if they don't work out, you're looking at this business here and you're thinking, it's still going to grow, you know, good amounts of profit and make good chunks of profit. It's still going to grow pretty decent on the revenue. And you're valuing this company like at 2017 levels at 12 times earnings. I can't believe it. Like, this is for me an amazing opportunity out here. Like, And normally when I invest in big tech, you've always got to have that realization that at 460 billion market cap, the chances of this like doubling is, you know, quite tricky, quite hard for these businesses to do it because they're so large. But I think at $170, this is easy for Meta to kind of double up from here. So I think it's a great opportunity. I mean, from a metrics point of view as well, you know, I mean, it's on a total enterprise value to revenues, it's half of what it normally is. If you look at any other metric, I mean, it's a lot cheaper than what historically it normally is as well. And when you look at the past performance, like it just generates so, you know, look at the growth that it's had previously. You know, it's going to still carry on growing good revenue, profit, great profit margins. I mean, that means it sits on so much cash on its balance sheet where it can do these. I mean, what cash is it currently sitting on? It's currently sitting on 43 billion in cash. You know, that obviously can go to share buybacks, investing into new products to kind of drive revenue forward going in the future. I think this is a fantastic opportunity. So I am buying a bit more Meta. PayPal, so another big tech that I'm prioritizing at the moment. I think this is a steal at $77. I remember 2 years ago thinking, I wonder if PayPal would ever go down to them sort of ranges again. If it did, it would be a fantastic opportunity, and it has done. And yeah, I'm buying this one. 25 times earnings, which I think is not too bad at all. When you look at PayPal, it's having some tough comps at the moment. It's also having to do with its exiting from its eBay partnership. So yeah, it's had a few quarters where it's kind of, you know, said, oh, this is going to be a tough quarter. But when we get to the back end of the year, I think we could be in a quite decent place for PayPal. And when you take out the kind of problems it's having, when you take out the eBay comps, the numbers are pretty strong. And when these tough comparisons go out the way, you're going to have a company here that is going to grow profit at a very good rate. You're going to have a company that is going to grow revenue still at, you know, a good kind of 15%. And to be buying a company that generates this amount of profit, pretty solid balance sheet, very good revenue growth, at this sort of valuation, I think is a fantastic opportunity. Without doubt, you know, at $300 it was, you know, overvalued. But to be, you know, at this sort of position now where it's back at $77, I mean, it hasn't been $77 since around 2017-ish. Maybe 2018-ish. And you look at the business now, you know, the buying back shares, the profit is a lot higher than where it was, the revenue is a lot higher than where it was, and sure, it's having a little bit of blip in the short term, but I think this is one of those where fear has massively taken over, and I think this will be one that you look back in a couple of years' time and go, can you imagine buying PayPal at $77? I think this is, once again, you know, I normally get these big techs and expect, you know, maybe a 2x upside. Same again with this one. I think in the next 5 years, I think this is more than a 2x upside in this one. I think we'll be, you know, pushing at least the $200 again in the next kind of 5 years. So yeah, I think this is a fantastic opportunity here. And the last one is Hims. So I'm sure many of you guys know me talking about this one. It's a bit of a smaller market cap. I am looking at Hims and thinking this is a 5x to 10x opportunity. Obviously, there's a little bit more risk because it's unprofitable, even that I think it could get to profit in the next 2 years, which I think a lot of people are overlooking because of its fantastic gross margins. But it's a bit of a smaller market cap, but this is in its hyper growth stage, and the growth that it's been putting in has been absolutely phenomenal. So yeah, I've been trying to get my average down on this one. I think I'm sitting around the $6 at the moment. And this company is just on fire. Like, honestly, I've not seen a company like this that just brings out 10 out of 10 earnings report after earnings report, and you're like, surely they can't have another 10 out of 10 earnings report, and they do it. And that's had no reflection in the share price. Like, this company is half of where it was when it came onto the stock market, and the company is so far ahead of where it was when it came onto the stock market. I mean, you look here, when it came onto the stock market, it was 94 million, and now, you know, it's you're making 320 million. And, you know, people will point out to losses, but them losses, you know, if you're very short-minded, you are going to miss a fantastic opportunity here. The gross margins are unbelievable. It's only doing it to reinvest into the company and help it grow. Them losses are going to come down in the next 2 years, and don't be too surprised if you see this making profitability. And I could easily see this, you know, start putting in 10 million, 20 million, even up to 50 million of profit in the next 2-3 years. And you start working that out on this current valuation with the growth it has. Fantastic opportunity. And even in the recent earnings, it just hiked up its guidance once again. And that's off another quarter where it just recently raised its guidance. The net losses are shrinking massively. So you can see here, a lot of that was to do with the SPAC coming through the SPAC. Revenue is growing at 93%, which is crazy. And when you look at the valuation side of it, I mean, total enterprise value to revenue at a 1. I've never seen a company that's been, you know, on fire this much, hiking the guidance up this much, growing at 93%, trading down at 1 total enterprise value to revenues. I've never seen it before. You know, it's insane. It's insane to be looking at this company at these sort of valuations. And it's also an owner-led company as well, which is really positive. So if we look here, Andrew Dunham is the second largest shareholder. In fact, this company has only been around for like 4 or 5 years as well, which is impressive to see that it's at this sort of stage now in 5 years time. Founder-led company, which is also really good and obviously holds a really good ownership as well, which is another massive positive here. So those are the 5 stocks that I've been buying. I think there's a good mixture in there. You've got like some big tech, you've got a dividend stock, you've got some hyper growth stocks that are a little bit more risky, which obviously offer the potential for more upside if it goes correct, which I think HIMS will do if it carries on pulling out the financials it has been doing. So yeah, a little bit of a mixture on them 5 stocks that I've been buying. So I hope you enjoyed the video. Let me know what you've been buying in the comment section as well. And yeah, I'll see you on the next video.